everyone, a very good evening. You're watching The Money Show on ET Now. This is your one-stop shop for everything to do with personal finances. I'm Rubina Kapasi, and here's what we have lined up for you on the show today. Well, first up, as we know, there have been a couple of new rules introduced by SEBI for mutual funds. They're all in the benefit of unit holders, more disclosures, more information available for you holders to assess whether they would like to continue staying on in this particular mutual fund. What exactly are these? How should you interpret them? And additionally, how important really is it for you to be going through each and every constituent of your mutual fund portfolio? Can that essentially ensure that you are not taking on more risk than you have the appetite for? Will it perhaps even prevent a Franklin kind of fiasco when it comes to debt funds? So we'll be talking about that and more, and later on the show we'll be bringing on board our Spend with TMS segment. Realty prices, of course, are at mouth-watering levels. So should you squeeze your finances to buy the same and travel with the new restrictions that have come in? Where can you really travel? What are the precautions you have to take? What are the documentation as well that you have to ensure you have in place is what we will be discussing. So first up, let's introduce on the show Harshvardhan Roongta. He joins in to talk about our very first topic. Harsh, it's a pleasure having you with us on the Money Show. Thanks so much for taking out time today. So to start with, how important do you think it is for investors to look into how a mutual fund that they own invests? As we know, a mutual fund, of course, invests in a series of stocks, 80 to 90 stocks as well, on a max basis. But do you think that they should really we get fact sheets every month? Now, of course, there's talks of mid-month portfolio releases as well. So do you think that every time the AMC or the fund house releases this fact sheet, an individual should be really producing that fact sheet for the constituents of the mutual fund portfolio?
Well, Movina, as much as we may say that an investor should definitely go into the portfolio, look into what's happening, on a practical level, for a layman investor, if you're talking about an individual investor with a non-finance background, it's very difficult for that person to understand. And quite frankly, I wouldn't recommend that a person goes into the fact sheet every month. It's a regulatory requirement due to which a fund house will be sending you these documents every month. Does not mean that you have to look into it every month. Now, most certainly, if there are some events happening, now we came across a situation, you mentioned the Franklin fiasco. Now, if the credit quality of your debt investments is deteriorating, of course, then you will want to look into what kind of papers your scheme is investing into. Now, with this mid-month disclosure thing that SEBI is talking about, it's a very, very good move, with a simple reason that an investor will know now within 15 days exactly what the credit quality of the papers in which your scheme is invested into is. In case you feel the quality is deteriorating, you can immediately exit out of it. So to answer your question, very simply, yes, as an investor, you must be a little more proactive than what you are currently, which means that you go into the scheme details, say probably once in 6 months, once in a year, and just kind of have a look. If your stakes are high, you've invested high, you've gone into low-rated papers, then of course you want to keep a track of it. As far as SEBI regulations are concerned, it's a very good move in the right direction for people who are really interested to know what is happening, and so that they can take proactive action.
So do you think, Harsh, since you've brought up that topic on debt funds, do you think that this whole bit where you peruse the fact sheets that are released every month, okay, maybe not every month, but maybe every, once in 2 months or 3 months, do you think that that is an exercise that perhaps debt fund investors should do more than equity funds?
Certainly, because debt fund investors are typically the conservative kind of investors. And equity is on the other side. It's like the kind of companies that they're buying into. The companies, the shares of which company they're buying into, which is kind of left to the professional fund managers, the good fund houses that you have. When we're talking about debt investors, typically the intent is to earn a fixed return on it. So may not be a coupon payment to them, but of course you're looking at conservation of capital, you're looking at safety, you're looking at a steady return. So you would most certainly want to know what kind of investments your scheme is doing. So if you're constantly buying something which is very low rated paper, then of course you will be worried about whether you get your money back or not. So you will need to look into more in detail considering what has happened in the recent past it's better that you keep looking at the quality of paper and move out of a scheme in case you're uncomfortable with the allocation towards, say, probably an A minus and below. So you might want to move to something which is more safer, say a AAA rated or something like that.
I know, Harsh, that my debt fund is investing in low quality papers. Does the fact sheet also give you the breakup of the credit quality where the debt fund has exposure AAA, AA, so on and so forth?
Yes, in fact, there are very good developments that are happening. You mentioned about recent changes that SEBI is bringing about for the benefit of unit holders. So one is, of course, you're answering your question. You will very categorically have the holdings of each paper. So when you look into the fact sheet, you will see that they've invested probably 8%, 10% into a particular the bonds of a particular company, and they're rated at say AAA, AA, whatever is the credit rating. In fact, going further, we will see security-wise yield also. So they will also know that this particular paper, the scheme is generating say 5%, 6 or 7% interest on this particular investment also. So this is something that we will see going further being introduced in the fact sheet as well. More importantly, the riskometer, like to place emphasis on the thought that SEBI has put into the riskometer. I think it's a brilliant move. What SEBI has now done is they have assigned numerical values. So they have assigned numbers to everything that a debt fund can get affected with. So one is, of course, they've evaluated a debt fund on an average basis on an average of all the papers. So they have to rate each paper and then take a simple average of all these parameters. So they're rating a debt scheme on the credit risk that they're taking, on the interest rate movements. What is the impact of an interest rate movement on the bond? Then they're also looking at the liquidity, how illiquid or liquid a particular stock is, a particular bond is. So based on this, there is an average which will be derived, and that numerical value will correspond with a riskometer, which is going from low to very high. So there are 6 levels, going from low to moderate, then there is moderate, moderately high, high and very high risk category. On the equity side, again there is numerical values assigned towards each risk that then equity investment could have. So one is my market capitalization, then what is the volatility and what is the impact cost. If it's a thinly traded stock, the impact cost will be high for selling or buying. So putting all these parameters together, there is a numerical value assigned. Based on that average of numerical value, there is a riskometer, there is the arrow pointing at a particular risk level. So an investor today can easily look at that riskometer and see whether you're investing into something within the same category. And this is interesting, Mubina. So earlier we had all short-term funds being categorized probably as low to moderate risk category. Now you will have say ABC short-term fund as low risk or a low to moderate risk, and our XYZ short-term fund has to be a very high risk also, depending on what are the constituents of that portfolio. So I think going further, starting January 2021, things are only going to get better for investors, and SEBI is to be given all the credit for this. I mean, working relentlessly towards and proactively towards securing the unit holders' interest.
Okay, so what it used to be earlier is that all short-term debt funds were automatically classified as low risk or medium risk, but now that's not going to be the case. Every fund house will have to look at certain parameters, and each fund will be given a category. The needle will point based on the 6 levels of risk from low to very high risk. So just because it's a short-term debt fund, you cannot automatically assume that okay, the risk of this fund is low. The mutual fund house themselves will declare what the riskometer indicates. In most cases, of course, it will probably be between the low to medium risk category. So do you think, Harsh, that this riskometer introduction is something that now can easily replace the tedious process, if of course people would go through with it, but yeah, this tedious process of opening the fact sheet, especially for equity mutual funds, going through the constituents, looking at concentration risk, liquidity risk, so on and so forth. Does this riskometer totally subsume all of that? So now as an investor, I simply just have to look at the meter?
Well, I wouldn't say to look at only the riskometer, because riskometer does a very specific job of telling you what is the risk this particular scheme is taking, given the parameters that we spoke about. But the evaluation whether this is appropriate for you or not, I mean, whether you're looking at a large cap, mid cap, multi cap, what kind of scheme you're looking at, whether it suits your investment profile, what you're looking for. If you're looking at making a core portfolio of your equity investments, you will not possibly want to add a small cap into that. The core portfolio will essentially be a large cap and a multi cap fund. So, Riskometer has a very specific purpose to say this particular scheme is taking this much risk. Whether you're willing to take that or not is different. The constituents, what kind of stock they're holding, which industries, which segments are they basically taking exposure into, how much of engineering, how much of construction, how much of financial consumers. So all that part you will have to deep dive into the fact sheet. But Riskometer will give you an indication of what is the level of risk given these parameters in equity, market capitalization, volatility, and the impact cost. Putting this together, what is the risk? So that is a very, very single pointed indication that the Riskometer will do.
Okay, all right. So that's essentially important to note. So, like you mentioned, Harsh, there are 6 levels of risk. For somebody, now of course we have all different kinds of investors, right? Some do have an appetite to take on board more risk. Some may not have that appetite. It may be based on their income levels, their goals, their current job status as well, because things are so precarious. Of course, in general, their age as well is another very important factor. So for different kind of individuals, what on the riskometer would you indicate is an appropriate level of risk? Let's take age as a parameter first, and income as well actually. So for low income and high income, for younger people and for older people, what on the riskometer arrow would you indicate is a good risk appetite for these 4 categories of individuals?
Okay, so very simply put, so if you are in a situation wherein the dependency on the money that you're investing is very high, so in case you need money at call, you need money for your some day-to-day expenses, you need money for certain goals which are probably 2 or 3 years from now, you will look at investments which are going to be on the left side, on the lower side of the moderate risk category. So anything which is in the first 3 quadrants, so it could be a low to a moderate or a moderate risk. I think that is the quadrant that you will look at for your investment needs which are short-term in nature, wherein you are dependent on that money. In case you have some long-term requirements, I mean, you're probably starting off, you don't need money for the next 20, 30 years, then of course you will want to take high risk. There's no point in investing into something which is low risk in category. So that is with respect to your timelines that you have, the dependency on money. But if you're looking at a debt investment, then even if you have a long-term view, it does not mean that you need to go for a very high risk. Because in a debt product, a very high risk means that you could be holding papers which are very low in quality, in credit rating. They could be illiquid and the impact of interest rate movements could be very high on them. Is that what you're looking at with your debt investment? That is not what you're looking at your debt investment even for the long term. So it depends on which asset class you're investing into. What is your time horizon? What is your dependency on that money? What is the continuity of income that you have and what are your goals? So this together, you would have to pick as to where can you take that risk. As I said, anything which is near term, go on the first 3 levels, which is low to moderate or moderate. For anything which is long term and which you're not dependent on, probably you could go and take a little higher risk, which is moderately high or very high. Equity, for that matter, in all respects will fall in the high and very high category. So you don't have a choice there. It is only into the high and very high category. Debt is something that you need to be very careful given what has happened with Franklin recently.
Okay, all right. So that's some important advice coming in from Harsh, essentially on assessing, your mutual fund. What kind of risks is it taking? Some wonderful steps as well brought about by SEBI to ensure that you, as the unit holder, know in a very simple language that to what your mutual fund is doing. Well, on that note, we'll slip into a very short break, but don't go anywhere. Harsh, request you as well to stay on. We've got some questions and queries from our viewers, and of course, don't forget, if you would like to connect with us, you can write in on the Money Show at etnow.tv. You can send in your portfolio to ask any personal finance related question. We'll be right here to get that answered. welcome back. You're watching The Money Show on ET now. We were in conversation with Harshvardhan Roongta on essentially understanding how you can assess the risk of your mutual fund. Come Jan 2021, of course, it's going to become a much easier process because of SEBI's new guidelines on the riskometer. So you should, while of course mutual fund investing is for the long haul, and you invest in equity mutual funds because you may not really be able to delve into the nitty-gritties of share trading or share investing, but still must keep an alert eye out for developments in the world for your debt mutual funds, more specifically, especially in light of the Franklin fiasco. Well, as promised, this is the show, of course, where we also take on board the questions and queries that you've written in to us with. Remember that you can always connect with us by writing in on The Money Show at etnow.tv. So we have the first question coming in from Subramaniam Pichai. He's one of our regular The Money Show viewers. He writes to us saying that I retired last year and he wants to get 50,000 rupees per month. I assume that would be his monthly cash expenses as well. Now he's saying he already has a corpus of 40 lakh rupees which he's invested in ICICI Balanced Advantage Fund, the growth option, but he's wondering if he should switch over to the dividend scheme. So he's already got this bulk amount, and I think all of it is in the ICICI Balanced Advantage Fund. Also, he wants to know if it's advisable to switch to a debt fund and what are the suitable funds. What should be the corpus one should have to get a 50,000 rupee per month for another 25 years by SWP. So I'm assuming he's roughly at about the age of 60 to 65. Harsh, unfortunately, we just know that he has this corpus of 40 lakh rupees. However, realistically, and let's just assume that this is all that he has, is it possible, to garner a 50,000 rupee per month monthly cash outflow, and that too for the next 25 years? And if maybe not 50, possibly a smaller amount, how do you think he could still properly invest this 40 lakh rupees to generate this annuity?
Well, Mubina, his question is into three parts, very clearly saying that I have 40 lakhs which needs to be deployed, and he is currently invested in the ICICI Balanced Advantage Fund. He wants 50,000 rupees every month, and he wants this 50,000 rupees every month for 25 years. So very clearly, I mean, if you're investing 40 lakh of rupees in any product, I mean, it's very unlikely that you will be able to every month. If that is the case, even if you're looking at an FD kind of a product, you need a 15% return on it per annum, which is not possible. So I think that part taken care of, is not going to be taken care of. As far as the other thing is concerned, when he says that, he's investing into, he wishes to invest into a debt fund, well, I don't think we should be doing that with a simple reason because his requirements are very high. Now, if he were to invest in a debt fund or a fixed deposit, as I said, he needs a return of about 15% annualized to meet his targets. So that's not going to happen. What he's doing currently is actually appropriate, where he needs to have some mix of equity in his portfolio so that he's able to over long term generate a return which is more than a fixed deposit or a debt fund that could generate. Equities do have a potential to give you higher return. Of course, they come with their set of volatility, which he will have to factor in. Now, given his requirements, the dynamic asset allocation category of funds is the most appropriate. He is rightly into the same kind of scheme. So, ICICI Balanced Advantage Fund is one of the finest categories. We know about that. My only concern is that if this is the only scheme that he's investing into, it's wise to have, diversified into 2 or 3 schemes of the same category. So while you can retain your ICICI Balanced Advantage Fund, I would suggest, split your total 40 lakhs into 3 schemes so that you're, well spread and you don't have any concentration risk. The other 2 schemes that you can add in your portfolio would be IDFC Dynamic Equity Fund and an Edelweiss Balanced Advantage Fund. So with these 3 schemes in his portfolio, you will have good spread across different fund houses and different fund expertise. And with regards to whether he should switch to a dividend option or continue with SWP, I think SWP is a better suggestion for him with a simple reason. He can control the amount of money that he wants to withdraw. Whereas in case of dividends, I mean, it's at the discretion of the fund houses to, announce a dividend and pay it out say probably once or twice or a couple of times during the year. So I think SWP is a better method for him because he needs a fixed amount of money every month. He cannot be dependent on the fluctuating dividend amounts that are being announced. And finally, an SWP is far more favorable from taxation point of view as well. And initially, the tax incidence will be very low as compared to dividends. So keeping all these things in mind, continue with your balance advantage fund category, the dynamic asset allocation. Just have split it within 3 companies. Stick to SWP and remove as much as you think you need every month. So set up an SWP for that amount that you need every month.
All right, so I hope you've listened in to how Harsh recommended you utilize this amount in the most useful manner, spread it across, Mr. Pichai. Okay, let's take on board our next question. Srinath Rajagopalan writes into us saying that I'm 40 years old working in a software company and he wants to create wealth for the next 10 years. He believes that he can just take moderate to high amount of risk. Now he's already got some money that he's invested in a couple of funds through a one-time investment, Direct Plan Growth, in October 2017, and he split it up exactly into these 6 funds: Aditya Birla Small Cap, BNP Paribas Mid Cap, Franklin Smaller, HDFC Small Cap, L&T Emerging, Tata Equity PE, 35,000 rupees in each of these funds. So it's 2,10,000 rupees which he invested in 2017. Unfortunately, post 2017, we saw this crash come by. Well, not exactly a crash, but we saw mid and small cap companies really, not doing much for investors. And unsurprisingly, these funds as well have not done very well for individuals like Sundaram. So what he wants to know now, firstly, is the mix right, Harsh? Because I'm sure you will agree with me when I say that there are way too many small and mid cap funds. And secondly, he wants to know if he should redeem, what are his exit options, and where should he reinvest the money that you may ask him to redeem, or what would be the shuffle you would recommend for him?
So very clearly, Mubina, you're right when you say that he's got his entire portfolio into mid and small caps with just one value-oriented multi-cap fund. And he also states that he can take moderate to high risk, and but that's not the kind of a portfolio that you will create with 100%, almost 100% into mid and small caps. Ideally, even investing in equities by itself entails that you're taking a little high risk. And within that, if you're assigning everything into a mid and small cap, then I don't think it translates into saying that you're willing to take high risk, because it's not the ideal way of constructing an equity portfolio. So what I suggest that he realigns his portfolio to have a little more balanced approach. So then have exposure into large, mid, small, in all sectors. He may undoubtedly allocate more towards mid and small caps, but he also needs to have some bit of large caps in his portfolio, so that overall return on the portfolio will be, the experience will be better than what he's enjoying today. I'll suggest the following portfolio to him. He can retain 3 schemes out of the ones that he already has. So he can retain the Tata Equity PE Fund, he can retain the Aditya Birla Small Cap, and the L&T Emerging Businesses Fund. I'm doing this because he wants to consciously take higher risk. So I'm retaining 3 of the small cap, mid and small cap funds for him. And all the other 3 schemes that he has, he can redeem one of those schemes and add a multi-cap fund, so which has a large cap bias right now, so which is a total standard multi-cap. So in this way, he will have a more balanced approach to his portfolio, and God willing, he will have better equity experience going further from there.
All right. Okay. So there you have it. I hope that's been able to help you out with a little bit, in your portfolio, a little bit of tweaks and changes that Harsh has recommended. Well, Harsh, really appreciate you joining us today on ET Now and, helping our viewers out with their questions and queries. If you would like to catch this interview, you can do so by logging on to youtube.com, finding the ET Now channel, and under the Money Show playlist. For now, we'll take a very short break. Don't go anywhere.